Hi, and welcome to Strategic Equity Management's second quarter economic update. My name is Jeff Hybiak, and I'm the Portfolio Manager for Strategic Equity Management. Today, as we do each quarter, we're going to take a look at our economic indicators and what they are pointing to as far as our economic recovery goes. Now, what we want to look at is our own leading economic indicators. There's all sorts of indicators out there, but I've been doing this since 1998 for strategic equity, and I actually started studying the economy back in 1994 using the Federal Reserve Economic Database when it first became available. And what I was able to do is kind of look at what economic indicators tended to point towards recovery, and what ones also gave us kind of a red flag as far as when we were heading into a recession. And so what we've been doing each quarter since I started with strategic equity is looking at the direction that all these indicators, when you combine them into one, are pointing to. And by looking at each individual indicator, we can kind of see what's important and what's maybe not so important to watch as we go through and try to navigate these difficult markets. Now, rather than going into each one individually, I would encourage you to go to semtradersblog.com, and I'm going to have a slide deck on there that shows a chart of each one of our indicators. But to just give you a general snapshot of what we're seeing as far as each individual indicator goes, we see three of them that are above trend growth that we're calling 3 to 3.5% GDP. So taking by themselves, three of these are looking like an economy that's growing well above trend. Those would be building permits, stock prices, and hours worked. Now, at trend growth, which is basically where we've kind of been hovering over the last 5 years, at around 2.5 to 3% GDP growth, we only have one indicator, and that's the number of jobs being created. And then unfortunately, we have three that are actually tracking below trend growth. So that would be consumer confidence, consumer goods orders, as well as supplier deliveries. And then we've also seen something that is really new since we started doing these video updates as far as our economic outlook goes, and we have two that are tracking at what we're calling stall speed, which is less than 1% GDP. That would be capacity utilization, as well as service business activity. Now, these bear watching, because if we start to see them dragging down some of our other indicators, or we see some of the below trend growth indicators fall back into stall speed along with these other two, we could be looking at an economy that's heading back into recession. But as for now, one indicator remains the key, and that is building permits. And the reason I like to watch this indicator is because the activity that you see in the housing market can be so stimulative to the overall economy. You look at the amount of things that go into building a home, from the materials to the jobs to the furnishings to all the surrounding activities in a community when a new home builds up. You can see how it can really get the economy going. And I'm not calling a final bottom in housing yet, but if you look at the way permits have risen, it does look pretty good. They've been rising at a very healthy pace. Now, they did fall last month in June, which is a bit of a concern, but it looks like a lot of that disappointment came from the multi-housing sector, apartment buildings and townhomes and things like that, did see a bit of a slowdown in June. So that's something we're going to be watching very closely, because as long as building permits are increasing, we expect to see continued growth in the economy. So it is something we will be watching. It fell from a 35% year-over-year growth rate all the way down to about a 15-16% growth rate in June. It's still a healthy clip, but it is a little bit slower than we've been used to. The problem we've had with our economy, and this will tie into our discussion of the Federal Reserve and interest rates, is despite everything the Federal Reserve has been doing, we have only seen 2 quarters of the last 15 where the GDP growth has been over 3%. And both of those quarters were actually on adjusted numbers, where they went back and kind of looked at the seasonal adjustment factors and said, well, these were wrong. And so after the fact, they raised them to an above 3% quarter. The fact that we have not been able to grow above that, despite what's now about $3.5 trillion of stimulus from the Federal Reserve, despite about $10 trillion of new debt added by our federal government should be a concern. And yet, in today's market, all anybody seems to be talking about is the Federal Reserve. Now, I found it interesting that beginning in May, the Fed started trying to talk down the market and kind of warning them that, hey, things are getting a little bit better. We are seeing excess risk being taken in the financial system. So we may begin to do what we're calling tapering the pace of quantitative easing. Now, that had a big impact on interest rates. They've since backed off of those statements, and in fact, they kind of went out of their way to tell people, hey, we may not start tapering anytime soon. Ben Bernanke's been out there telling people, we just don't know. There's no set timetable. If the economy continues to be weak, then we're going to go ahead and keep the foot on the gas pedal, if you will. So to really understand what's going on, we got to take a look at the Federal Reserve balance sheet and what quantitative easing really is. Now, the blue line here on this chart is the Federal Reserve's balance sheet. So anytime they're creating money, or what other people have called printing money, that balance sheet line, that blue line, will go up. And what I find interesting is to track what they're doing with that money and where it's ending up. So if you look at the green line, that's Treasury securities. So that's all the time the Federal Reserve's been using new money to purchase treasuries. And also the pink line, which is mortgage-backed securities. And you can see the different iterations of quantitative easing there on the chart. And what I noticed, though, is that red dashed line. And those are the bank reserve balances. Now, those reserve balances are basically money that the Wall Street banks, or what they call primary dealers, are able to keep on deposit with the Federal Reserve. So the way quantitative easing works is the Federal Reserve can't buy Treasury bonds directly from the Treasury Department by law. It has to be sold to primary dealers at auction. And so these primary dealers are able to go in and at a discount buy the Treasury bonds, and then the Federal Reserve, through what they call permanent open market operations, or POMO, goes in and they say, okay, today we're going to buy X amount of dollars of Y duration treasuries. So it might be, today we're going to buy $2 billion worth of 7-year treasuries, with an expiration date 7 years from now. And what they'll do is the banks will put in how much they're willing to sell the Fed. The Fed goes through and they clear those trades. By the way, the Fed pays fair market price while the Wall Street banks were able to buy them at a discount. And then they credit the accounts of the Wall Street banks. Now, the Wall Street banks are able to either take that money and leave it on deposit with the Federal Reserve, and that's that red dashed line, or they can pull it back out and do what a bank's supposed to do and actually lend money on it. What the banks have done, though, as you can see, is pretty much every time the balance sheet has gone up, they've gone ahead and just kept their money on reserve. Then they can take the reserve deposit and use it as collateral to borrow money to do other things. And what we've seen, again, through the financial statements of these Wall Street banks is they're putting it to work in the market. So that's had a big impact on what the Federal Reserve has been doing. Now, the issue we have is if you look at QE3 and QE4, they're buying about $85 billion of treasuries each month. If you take that times 12, you end up with just over $1 trillion worth of purchases on an annual basis. Well, when the year started, when we started QE3 and QE4 combined, the U.S. government was running about $1 trillion deficit, which meant they're going to have to borrow about $1 trillion just to keep everything running over the next year. Well, remember, we had the sequester cuts as well as all the tax increases that were part of the fiscal cliff. Now, what we've seen happening is through the end of May, we're only running a deficit of $646 billion. Now, I use the term only very loosely because that's still well above even the deficits George Bush was running back in the recovery years of 2003 to 2007. But when it's down from $1 trillion, that's a pretty big drop. What we've seen happening is we've seen revenues are increasing at a very rapid rate. Spending, although, has been flat. And you might say, well, how can that be possible? We had the sequester cuts, right? We did. We had cuts to defense and we had cuts to other discretionary items. Unfortunately, all the increases in spending in Social Security and Medicare have wiped out all of the sequester cuts. So what the government budget looks like now is we see revenues higher and spending flat, which means still we have a lower deficit. So now here's the issue. The Federal Reserve is not only buying newly issued treasury bonds. Now, as the U.S. government's borrowing less money, they're buying more and more of the already issued treasury bonds from the banks. So they're pulling money out of the system. They're pulling those treasury bonds out of the system. So there's fewer of them out there, which can create volatility, which can make it more difficult for the Federal Reserve to manage rates. Now, we saw a brief snapshot of what can happen if the market even thinks the Federal Reserve is going to pull back. When we saw treasury bond interest rates on the 10-year go from around 2.5% all the way up to 2.7% in one day. That's a very big increase. And what we've seen happening is also mortgage rates increased. And that goes back to our number one indicator, which is building permits. If we see mortgage rates increase too fast, and it makes it more difficult for people to borrow, then we could be in a lot of the trouble. However, this is something that I don't understand why the Federal Reserve hasn't really caught on to this, because they've talked to us a lot about deflation and how bad deflation can be for the economy, because it gets people to sit on the sidelines and hold on to their money and they don't feel like spending it. Well, what we saw was very interesting over the last month, in that as prices of houses increased, as well as interest rates on mortgages, we saw increased activity in the housing market. We also saw increased number of homes going onto the market. And more importantly, if you look at this red dashed line, we actually saw some of those reserve balances enter the financial systems. And the reports from the Realtors Association is bank lending standards actually relaxed once interest rates went up. So think about it. If you're a bank and interest rates are 3% for a 30-year mortgage, when you can turn around and just flip bonds back and forth to the Federal Reserve, you think, okay, why would I lend somebody money at 3% for 30 years when I can just keep flipping bonds back to the Federal Reserve and making a profit that way? Oh, by the way, they get 0.25% interest on those deposits, which can really add up for a large Wall Street bank. But as interest rates crept up, as well as the prospect that the Federal Reserve wasn't going to be buying as many treasury bonds, then the banks started saying, well, we better start lending money. So you could see a little bit of a drop in the reserve balances there as they relaxed their lending standards. Unfortunately, the Fed has come back down and they've said, we may do this for a long period of time. So that means we're probably going to get back to the mode of Wall Street banks are making a lot of money on this, but they're not willing to actually be lenders and keep things going in the economy. So it's going to have to be closely watched what the Federal Reserve is doing. Now, stock prices have really been reacting to what the Federal Reserve has been doing. If you could see, the blue line is still the Federal Reserve balance sheet, and since the recession ended in 2009, you could see how the stock market has basically tracked the direction of the Federal Reserve balance sheet. There's been a few times where the market got ahead of the Fed and saw that QE was ending or QE was going to start up, and they jumped into stocks ahead of time. But for the most part, when we've had quantitative easing, the market's gone up. Now you can see just the mention of a slowdown in purchases. Remember, the Federal Reserve didn't say we're going to stop quantitative easing. They said we're going to scale back the level of purchases that we're doing. And you could see what happened. The market panicked. Now this is something that has really created a dicey situation. Because if you look at the textbooks, which is all most people have to go by, including the Federal Reserve, what's happening with interest rates is a little bit of a concern. In a normal economy, if you see the economy's doing better, you're going to see government interest rates on those safer bonds go up in yield. And then of course as the economy weakened, you would see them go down in yield. Now if you look at the other end of the curve, like high yield bonds or emerging market bonds, if the economy is getting better, you actually see their interest rates go down. But what we saw at just the mention of tapering, because remember, the Fed said they would be tapering because the economy was getting better. But we saw both government bond yields spike. We also saw high yield bonds spike, emerging market bonds, AAA corporate bonds, muni bonds. They all spiked up. Well, when interest rates go up, those prices go down. So we saw just in a few week period big losses both in bonds and in stocks. So having a diversified portfolio didn't really help you. And this is where I fear the market is going is, Ben Bernanke himself has said, these are unprecedented actions that the Federal Reserve has taken to try to save the U.S. economy and the banking system from an unprecedented recession. Well, unfortunately, we've also seen that we don't know how it's going to end. We know that the interest rates should be significantly higher. We don't know how many people will buy bonds. We just don't know what's going to happen if interest rates spike up too much. That's the unknown. And that's where strategic equity management really comes into play, is we can help you battle the unknown. We are active money managers, and during this few-week period where we saw the market dropping all across the board, we took defensive steps. We moved into money market. Now as the Federal Reserve has kind of talked the market back down off the cliff, we've seen the markets rising, and so we've stepped back into the market. But the key is, if you get into a market like 2008, or like 2002, or any of those other times, even 1994, we have a plan, because we've been around since 1992, to try to mitigate the risks that are happening in the market. You don't have to buy and hold with your investments. There are other methods to get away. Remember, a diversified portfolio during those market shocks like we saw a few weeks ago, where bonds and stocks and gold and everything else all went down together, that's when you need diversification to help you the most, and that's when diversification usually fails. We don't know what the rest of the year is going to bring. We're going to be watching the economy very closely. We're going to be watching what the large institutions are doing with their money. But I do know one thing. We will be back for the third quarter economic update. Hopefully we're going to see those economic indicators picking up steam. Hopefully we're going to see the market acting a little more normally. If not, go to our website, stratequity.com. If you want to check out our daily blog, you can register for our site, either as an individual investor or as a professional, and you can see what we're doing in real time each and every day. Until then, my name's Jeff Hybiak, Portfolio Manager of Strategic Equity. Have a good quarter.